Welcome to Bloomberg Television. In a moment, you'll be able to watch your interview. But just before that, let me show you who'll actually see this interview. 67 million homes throughout the world have access to our UK channel. And although the bulk of our audience is based in the UK, we also broadcast to most European countries, the Middle East and North Africa. Every day, we interview fund managers, analysts, chartists, economists, strategists, and all the other key players in the financial industry. We make it a point to tell our viewers about all the companies that are making or are about to make the news. That means we speak to the CEOs, chairmen and financial officers, not just from British companies, but from those around the globe. And don't worry if English isn't your first language. We broadcast in French, Italian, Spanish, Portuguese and Japanese. OK, that's TV. But what about this, the Bloomberg terminal? 250,000 people, mostly business and financial professionals, use the service. There are three areas that corporations find the Bloomberg invaluable. Firstly, investor relations departments use the Bloomberg to aggregate and interpret all information relating to their company and industry so that they can monitor the company's performance and accurately communicate this to both management and analysts. Secondly, Bloomberg's money market product lets a treasurer monitor all the money market rates, make value comparisons and evaluate historic trends to select the best investment or borrowing vehicles. And finally, if you're an investor, the Bloomberg terminal can help you find out about the long-term financial health of a company and whether it's likely to provide good value for shareholders. That's enough about us. Here's you.
Cheers, Chantal. Well, on Friday Fund Focus, we're going to be discussing the performance of hedge funds so far this year and the latest performance figures from the industry. Well, for more, we're now joined by Jacob Schmidt, Director of Hedge Fund Research at Allen Bridge Group. Jacob, good morning. Thank you very much indeed for coming and welcome back.
Thank you.
Now, hedge fund returns are lower across 2001 than in previous years, but that in a way surprises me because I thought they were designed to provide returns in a declining market.
Absolutely. It was surprising also to us. The purpose of a study which we published today was to show where returns for both single managers and multi-managers have been heading for the last couple of years. We looked back to 1996 and analyzed the performance both of single managers, these are hedge fund managers, and multi-managers. These are portfolios of underlying single managers. And we found that the median performance, the average performance of a sample of 2,000 hedge funds, 1,800 single managers and 300 multi-managers, brought us to the conclusion that the median actually the trend is downward sloping. So the average performance is around 3% for both single managers and multi-managers year to date.
So what has gone wrong?
Nothing has gone wrong. I think we are just in a growth phase where many people are coming to the market and are trading similar strategies, number one. Number two, the times of the very aggressive hedge funds are over. The times of Soros, Steinhardt and Julian Robinson are over. People who are trading in the markets now are much more risk controlled, so they have less exposure, they have better risk management and so on. So volatility is also much lower. We have not looked at volatility at this point in time. I think that's very important to consider here too.
That the amount of activity, trading volumes on the bourses at the moment done by hedge funds is rapidly increased. Is there a problem in the sense that something you just talked about, which is them sharing the same strategies, that if they're caught wrong-footed, it could mean that the effects could be magnified?
I think not really, because if we, for example, look at the hedge funds trading in the FTSE in the UK market, it's still a very small amount of stocks they're trading. So the effect for the market, I think, is minor. Yes, they can move a certain stock, and there have been rumors that certain stocks have been affected by that. I think they just trigger that and they just accelerate it. I think the problem is more for the industry. If they trade in similar strategies and they get wrong-footed, for example, in September, some funds were long because they thought it would rebound, and then it was the tragic WTC attack. That hurt many funds, and we saw some funds down 15% or so.
There's always a health warning which goes with investing with hedge funds. I think we've had so many people saying, be very careful about where you go in. What's your advice?
Absolutely. I think what it shows is, and our study shows that it makes a lot of sense to go with multi-managers, because a multi-manager is a fund of fund who picks the funds for you. You don't want to be with one manager and one strategy. You need to be in different strategies because they react in different times.
But the charges are higher.
the charges are higher. But what we've seen in our study is that despite the double layer of fees, underlying fees and the fees for the multi-manager, the performance for the multi-manager is respectable.
Jacob, thanks very much indeed for joining us this morning. Jacob
Pleasure,
Schmidt, Director of Hedge Fund Research at Allen Bridge Group.